All right. Yeah. Once again, good morning. We are on now chapter 9. Chapter 9, which is annuity. Probably we may finish it up today. I think somebody begin the exam later in the day. So we're gonna help the person to go. Even if we did not finish annuity content, we still go and review the questions in order to help the person that will be going for exam by 11 a.m. this morning. So that's what we're gonna do. We always say anybody that's going for exam, we make sure that the person pass. That is the ultimate goal. So we talked about annuity as a blend of insurance. Annuity blends insurance and investment features. It has a blend of insurance and investment features. You can notice that since we have been speaking about life insurance. We have not talked about investment, but now we entered annuity. We are discussing annuity as a blend of insurance and investment. So we went ahead to say that annuity is a retirement product and that it provide protection, a maximum protection, and not only it provide protection, it provide a reliable income when you need it. As a bridge between the savings that we have, which is part of the retirement, based on how much you have accumulated, it becomes that annuity is a traditional source of retirement income. Annuity use long-term retirement savings. When you have annuity, you already made a long-term retirement service. So since it can act as an insurance product and also a guaranteed income, meaning that it protects you in other way. And as an investment product, it has a very good growth potential, more especially when you have a fixed index. So it has a very good growth potential. It can grow as much as you can invest, and moreover, depending on when the modality, the funding. So that is the most important thing that is here. In annuity, we have fixed, variable, and deferred. That's the three types of annuity. We're going to separate them one by one and be able to analyze what each mean and the relationship it has with each other. Again, the relationship we have with tax and the deferred growth. So those things are things we're going to see. And the protection from market volatility, which means when you are into annuity, it protects you from market volatility. And I hope everybody understood what the meaning of volatility. You know, one fear of a businessman or anybody who invests his money, his fear is always the downturn. That is when the investment dipping down instead of going up. That is the fear of everybody. But annuity tries to protect you from market volatility. So, however, based on that, we have three key benefits of annuity, which is tax-deferred growth. Earnings are not taxed until when you start withdrawing them. And depend on the funding again. Your withdrawal now depends on where the fund come from. If the fund come from after-tax money, meaning the principal are not going to be taxed, but rather the interest is taxed. Another key benefit is income for life. Annuity provides reliable income stream for life. If you invest well, it will provide you income for life. And market protection, when you are exposed to market volatility, there is tendency that you may lose what you have. I said it, I use myself as an example based on what happened to my 401k. So that is 401k is exposed to market volatility. So meaning that you can lose and you can gain. But annuity protects you from market volatility through its fixed and index options. So it protects you against losses. You don't want annuity don't want you to lose. So that's why it's one of the great tools you can use, portfolios can use to protect your retirement and retire in a very good note without losing After working so many years, hoping that when you retire, at least you have made an income that will take you all through your retirement, you end up not seeing that income, I mean that money not being in your pocket is very devastating. Honestly, some people may not understand it until you see somebody who have the experience. After working for 40 years or more than 40 years, hopefully that, oh, when I retire, I'll be okay. It's just like I told you, some people are richer when they retire. It's true. So such person will have the mind that, look, I'm gonna end up retiring wonderfully with my family, enjoying my retirement. Then when they discover that their money has dipped down without them touching it, it's very, very devastating. And then you cannot go front, you cannot go back. You don't know you don't know what to do because you cannot go back to work. The age is no longer on your side. The strength is no longer on your side. The health is no longer on your side. So it becomes very, very devastating. So that's one of the things we will not allow people to experience. In as much as some of them may not believe you, in as much as some of them may not believe you when you speak to them, just like they don't know you to be a pastor. Then you wake up in the morning to begin to go to their house and begin to pray, preach, talk to them about Bible. They will be looking at you as somebody who is crazy. So they see you being a nurse or being a medical doctor. You come out one day, begin to talk about finance. They see you as if you are not serious. They don't know what you're talking about. But however, being here has enabled you the understanding and everything you need to even to talk to them with confidence and look, you know what you're saying. So let's go to where we stopped last night, our annuity, see whether we can get it done completely today. I think we stopped somewhere at 41, if I'm right. Either 41 or 51%. No. All right. We are on classification. I hope so. I think it's here classification according to when benefit begins. I think that should be where we stopped. Anybody can help out to remember where we stopped?
The classification according to when benefits begin.
All right, that's where I am now, I think. Yeah, that's that's where I am now. All right. So we're gonna go ahead and almost everybody's here. All right. So remember, I said there's 5 classifications, 5 ways, and I said for you to understand this annuity is something sometimes it's confusing. Even me that is moderating it, I'm writing some things down because it's confusing. So for you to get it well, you must have to do what? You must have to at least write something, jot something down. Those 5 classifications are the basis of confusion. I'm telling you. So we're gonna look at a classification according to when benefits begins. That is when accumulation begins. That is when funding begins. So, you can fund it in any way. You can fund a single premium or you can fund a flexible. Depending on how much you have, you can fund any way you want to fund in annuity. So, another classification is that when benefit begins. Benefit is when you begin to pay, when payout begins. That's when amortization begins. So that is another classification. Remember the first classifications. Now we are classifying based on when amortization begins, when payout begins, or the payout phase or distribution phase begins. So annuity may be described according to when the payout or distribution phase begin. In other words, they may be characterized as either immediate or deferred annuity. Remember, we saw it on that classification, immediate or deferred annuity. For immediate annuity, it begins immediately within 30 days. So to you, anybody here, immediate annuity, what does he go with? Does he go with, excuse me, sir, please, excuse me. Sorry, please. So we talk about the immediate annuity and deferred. Of course, that's the two things. If you remember the first classification we did, you see that we classify based on when you are paying in, when you are paying the money. Now we are classifying based on when you are trying to benefit from the money. You understand? So it's two. So you can link two of them. Like when you are paying in, how do you pay? Is it you do a lump sum or not? You can now relate it to when you are benefiting from the money. I mean, from from what you put in. So one, it can be immediate or it can be deferred. Immediate annuity begins paying immediately. 30 days immediately you start you finish the accumulation because you did a lump sum. So you can see that immediate annuity goes with that lump sum. That is the benefit starts 30 days to 1 year, immediately you pay. Then deferred annuity begins paying benefit more than 1 year in the future. So it can relate two of them, see that they are the same. So let's go to immediate annuity. An immediate annuity is designed to generate an income stream to the annuitant soon after it is purchased. That is, immediately it is purchased, it will start to generate benefits. So it's left to you to say whether you want to start collecting the benefit. Of course, you should understand that if you start immediately to collect the benefit, there'll be no interest. Because the essence of investing is to ensure that there is interest, so that when you begin to collect, when the annuitization starts, what happens? You'll be collecting the principal and the interest. So if you invest and start immediately to collect, it's like you put your money and you're taking back your money. So that's the more reason why, if you do lump sum, even if you said you are going to do immediate annuity, you're going to do it based on, you're going to give a time that you will start to collect, giving it time to get yield and interest, so that your collection now will be, your payout now be based on the principal and the interest yielded. So the first installment payment to an annuitant can begin as soon as 30 days after the annuity is funded or purchased. The first income payment from a single premium immediate annuity must be made within 12 months of the contract date. The first income payment from a single premium annuity, immediate annuity, must be made within 12 months of the contract date. So this ones really give you the opportunity to say, if I put in 12 months' time, I will have to collect with the first payment. But can you zero it to show that you don't want to collect in 12 months? Of course, it's possible. It's contract terms. And the one you start collecting within 12 months means that will not be the same as compared to that person who keep his own for almost 10 years. That is the basic truth. That is the basic truth. So, and if you want to do for income for life, you can't use immediate annuity to do it, because you have to give it time to yield interest. So an immediate annuity can only be funded with a single lump sum premium. This means that there is no accumulation period. Since only a single payment is made, no income will be paid to the annuitant until they have paid the lump sum to the insurer. The income payment made to the annuitant consists of both principal and interest. So the principal and interest as the income that we pay to you, depending on what, how long did you allow the annuity to stay, the accumulation period to stay. Since lump sum, in lump sum payment, the accumulation period, there's no accumulation period. But still you have to leave it to invest itself before you can start collecting. So as with annuity, the period during which the annuity generates income for the annuitant depends on what? The total amount contributed to the new account and the settlement or distribution option selected. All right, so this one will now bury whatever we are discussing here. If you just put and now you start to collect, it depends on what the total amount you invested or the total amount distributed to the income, contributed to the income, which is the total amount invested. And again, the distribution option you selected. If you select a settlement or distribution option that is immediately 30 days after, do you think you're gonna get more income from it? No. So you're gonna select a settlement or distribution option that gives space for what you put into for the contributed account to have interest. So that's what it is in immediate annuity. It's a very good way to invest, honestly. If you analyze it critically, it's a good way to invest. The key thing I like in it is that protection aspect where you do not lose. And a specified interest is pegged in every account. For instance, all companies have their interest, the lower interest they will say, look at where you will not go below. So you have series, a lot of them. Immediately you pass the test, it's just you and you have a lot of them on there for you to choose which of them you like. Moreover, what I mean by passing the test is this: I told you how to calculate your investment with your earnings, all those put together. They want to know that what you have as an asset will be more than their debt. If they found out that, then you passed. If you pass, then they will bring out all the annuity companies around. And all those annuity companies, about 90% of them are life insurance companies. Then about 10% are just companies that are only specified, only what they do is annuity only. So let's look at immediate annuity timeline. If you look at this graph, contract established, lump sum premium paid, contract purchased. That is day zero. So you purchase this contract, you start this contract at day zero. Let's assume today, 29th. You are expect to, after purchase, after the 30 days of purchase, you can do your first payment, which means you can start getting your payout. The amortization can start. The day zero is the accumulation. There is no accumulation period in immediate annuity. Please understand that there is no accumulation period for immediate annuity. This accumulation is only one day. Then the 30th day, you start payment. After purchase, typically 30 days first payment. You can see the first payment, you start here. You don't have any interest on there. Go to this, continues your regular payment, which is the second payment, which is your payment is every 30 days. Then come to day 90. You can see in that day 90, which is about 3 months, you have getting a little bit interest. That's why your payout now will be principal plus interest. But if you look at this, the 30 and the 60, what you are paying, they are paying you is only your principal. But at the 3 months after, you may have got small interest there. So you'll be paid principal plus interest. So you can see. So the more you leave it to stay there and build up, the better for you. So if you decide to do a single lump sum premium where you start collecting the money, then it's left to you. And they're telling you that the first payment must occur within 12 months of contract debt. So you can collect it within the first payment, 12 months of your contract debt if you do immediate annuity. But believe you me, most people do not abide by this. You may not allow this to happen. You can use several settlement options, which we are going to see as we go on. All right, so now we have to deferred annuity. This one is most people also invest on deferred annuity because it's not like immediate annuity where you can start collecting after 30 days. No. This one, you have to specify when will you start collecting it. You can say 10 years from today, 5 years from today, 2 years from today. But I know most annuity are 5 years. Most of them start from 5 years, some 10 years. You know, some people go as far as doing 15 years. If somebody is young, there's no need. If somebody is young, that person can make it on 30 days, 30 years. Of course. Let's assume somebody buy annuity when he's 30 years. You can start to collect it around 65 years. That's the truth, which is almost 35 years. Then if you are below 25 years, you can even make it up to 70 years. I mean, to get it up to 50 years before you start collecting. Yes, it's possible. So the earlier the better in annuity contract. That is the best. The earlier the better. Anyway, it's the same thing in life insurance. The earlier the better. But this one we can see this one as an investment. It's just like you give somebody your money to trade with, and the person is paying you principal and paying you interest. That is exactly what it looks like. So for deferred annuity, unlike limited annuity, be funded with any premium payment plan, single premium, level premium, or flexible premium. So that's why most people are into deferred annuity, because it's funded with a lot of payment plan. You can do single premium, which is lump sum, or you can do level premium, which is the same amount of money. If it's 5,000 every year, you pay 5,000 every year, no increase, no decrease. Or you can do flexible premium, which means you can be paying in 2,000 this month, another month you pay 1,500, another month you pay 20,000 to the account. So in deferred annuity, you have payment plans, single premium, level premium, or flexible premium. Depends on the one you think that can work for you. So in deferred annuity, there is an accumulation period. But what in immediate annuity, there is no accumulation period. But in deferred annuity, there's accumulation period. So that's what you should write down as a difference between the two. In immediate annuity, we do not have what? An accumulation period. But in deferred annuity, we have accumulation period because look at the payment plan. You can do single premium. You can do level premium. I told you, anytime you see level premium, it's flat. It's fixed. It doesn't change. It's the same. Level term means what? Level premium means that it's fixed. Level term is fixed. The date the policy gonna end is known. It's level term. Level premium. The premium is the same. It does not change. Unlike when you go to flexible premium. Single premium is once. Level premium is the same amount, the same day. Every day you are paying the same amount. Flexible premium, you can change the amount you are paying in. You can decide to pay it today. You can decide to pay it next tomorrow. You can decide to pay, and the amount varies. But if it's level, you are going to pay the same and the same fixed period. So this classification of deferred annuity also differ from immediate annuity because it includes an accumulation period. Of course, you should know that, write it down on your notes, that deferred annuity has what? Accumulation period. But immediate annuity does not have accumulation period. What does that mean? It means there is a lengthy period between the contract purchase and the start of the income or annuity phase. That's another major difference again. Unlike the immediate annuity, where you can start the payout or annuity phase after 30 days. For deferred annuity, it's not like that. You can have a lengthy period. Some people can say 10 years, some people can say 5 years, depending on your age. So the earlier the better. So a deferred annuity emphasizes the safety of principal, asset accumulation, and tax-deferred interest. Remember, depending on the funding, the principal are not taxed, depending on the funding. If it's after tax, the principal are not taxed, but your interest is taxed. And the taxation on the interest is deferred. What do you mean by deferred? You can only be taxed when you are withdrawing. If the principal is from after tax, which means the funding is from after tax, no tax is there. But this is pre-tax, there must be tax on the principal and tax on the interest. Please, you have to understand that too. Remember it. So therefore, a deferred annuity is what? Helpful for any person seeking to or defer income until the future, which is retirement. So this is the most important one that people go into. I think I did it. I did this one. Deferred annuity is what? Helpful for any person seeking to defer income until the future. That is until retirement. I think everybody goes for this. Contribution may accumulate over time, and each year the insurer credits the fund at a specific tax-deferred rate of interest. So you are getting your interest, your money is building up day in and day out. It's not like immediate where you just put now, you want to collect it. No. This one is deferred collection. So when you decide to receive cash from the fund in the future, they have 3 options. That is the payout options for deferred annuity. Payout option is 1. You can say, I want to collect this money, lump sum, with lump sum distribution, of which the credited interest portion is taxable. I said your interest must be taxed. The accumulation must be taxed. The accumulation interest must be taxed. So if you do lump sum distribution, which means you want them to give you the whole money at the same time, what happened? They will tax the credited interest portion. Then you can say you want systematic or periodic withdrawal taken from the accumulation account. You can withdraw what? Periodically. Some people will say monthly, some people will say every 3 months, some people will say every 6 months, some people will say every 1 year, every year. So it depends on what you want. It can be systematic or periodic withdrawal. Again, amortization, that is the conversion of the accumulation fund into an irrevocable structural income stream so as to receive guaranteed monthly payment. You see? So if you imagine somebody invest on time, you open this contract on time. Let's assume when somebody is maybe 10 years or even 20 something years, you have this account. You put the contract, you put it for payout period to begin by. Let's assume you open the account when you are 25 or when you are 20 or 30, let me say 30. Then you defer it for maybe when you are 20, which is 20 years, which is 50 or 55. Then when you get to 55, you now do what? You amortize it again, which means you convert the accumulated fund into an irrevocable structured income stream, meaning you reinvest it again. Imagine what will happen. Let's assume you invest it again for another 10 years. That is both the accumulated and the principal, you reinvested it again. That's what they mean by amortization, the conversion of the accumulation fund into an irrevocable structured income stream so as to receive guaranteed monthly payments. So after that period, you reinvested it again, meaning the principal and the interest are put back into annuity. What we don't want to do, that will guarantee you a good income stream, monthly income, irrevocable income stream for life. So you see that there's a very big ways to build cash. Honestly, imagine somebody have some money now. You go to the children, you put 30,000, 50,000 annuity for them. Imagine what it be. Put it for them, they are, maybe some of them are 15 years now, or 16 years. You put it for them at that age. Then you allow it for a period of maybe another 35 years. Then after that 35 years, is reinvested again to another 20 years or 25 years. Imagine what will be in the account. It will be so massive. Honestly, it will be so massive. So there's a whole lot of way to, if you know, there's a whole lot of way to want to prepare himself. Not only prepare yourself, but prepare the grandchildren, because depending on how much you fund, if you have big money to fund, you can't be able to finish the money and you've passed, then the children come up. One thing is that the money doesn't stay stagnant. Wherever you put it, it's still yielding compound and yielding interest. Whether it's being used or not, whether there's a payout or not, the money is still building up for you. So let's look at classification according to the source of income. Some annuities are classified by their investment configuration or the source of provided income payment. The investment configuration affects the income benefit paid. For this type of classification, there are two types of annuity, fixed and variable. So you can see why I say this thing is confusing. Now we are classified. That's classification we made before. There are 5 of them. We are now on this classification according to the source of income. Now, in the source of income, you have 2 types of annuity, the fixed annuity and the variable annuity. The fixed annuity and the variable annuity. The 2 types of annuity you find when you classify annuity based on source of income. In such, you have fixed and variable. You see, if you don't write it down, follow it sequentially, honestly, even if you are like, let your brain become computer, you miss out. You miss out. So go to that classification based on source of income. Right under that, you have 2 types of annuity. We have fixed and we have variable. Write it that way to help you. Source of income, classification based on source of income. You have 2 types of annuity there, fixed and variable. So let's go to fixed. Let's know what fixed and variable annuity is. It's a fixed annuity pays a guaranteed, predetermined, or level benefit payment amount during the annuity phase. A fixed annuity pay what? A guaranteed, predetermined, or level benefit payment amount during the annuity phase. So you have to know the two plays. You see, even me, I write, sometimes I write some of them down. Because when you are reviewing, you are learning too. So when you are speaking, like when you start the business, you understand that you need to, it's continuous education. It's continuous education. So fixed annuity pays guaranteed, predetermined, or level benefit payment amount during the annuity phase. The premiums are placed in the insurance general account with other non-variable product premium. These premiums are invested in fixed rates product, e.g., CDs, bond, etc., to provide a fixed return based on interest rate guarantees. So these contracts what include minimum interest rate guarantees and may pay higher rates based on current economic market condition. So you see why people goes to fix in as much as it's based on current economic market condition. The rates are very high. The rates of returns are very high. Not someone should leave me alone. Please, sorry. Yeah, sorry. So is whenever I see me answer call like this is is all his clients calling or some agents calling to ask for clarification. Sorry, I'm very sorry, please. All right. So you can see that fixed annuity, everybody goes for it. Why? Because of that higher interest. The higher interest pushes everybody to go for it. You know, when it's fixed and indexed, honestly, everybody goes for it. It's very higher rates. The interest is very high. Depending on the market condition. If the market condition is so good, such as that time when stockholders or what do you call it, those who trade on stock, if that time they are making good money, the interest thereof is very high. If you now talk of the stock, let's assume the stock is making, maybe the market condition is so favorable to them, they are making good money. And that it can drop unknowingly, it can drop at any time. But this one, even if it drop, it doesn't concern you because you cannot lose. You only gain. So that is a great difference between this one and any other thing. The stock, if your money is there, you lose, it's gone. But this one, if there is a loss, you do not participate in the loss, you only participate in the gain. So you can see why it's favorable, why it's favored, why people should go for it. So let's look at variable annuities. In variable annuity, premiums are placed into separate accounts. These funds are invested in securities such as what? Equities, e.g., common stock and preferred stock, or debt security. There's something I want to tell you guys now. Please, we have variable insurance and variable annuity. Please remember that we have variable. When you see variable product, they're asking you of those bonds, some like security and bonds, all those things that you cannot put your hand on, because what? We do not have license to sell them. We cannot sell variable product because we do not have license to sell them. Before you can sell variable product, you have to have what? Security license and life insurance license. So if you get your life insurance license now, if you prefer to begin to go to say bonds, say security stocks, say mutual funds, if you want to sell those ones, you can, but you have to get what we call security license. So sometimes they will ask you that in the exam. So you have to know security license plus life insurance license before you can save variable product. And what are the variable product? Bonds, mutual fund, stock, and some security accounts, security equities. You cannot sell them at all. Common stock and preferred stock, you cannot sell them at all. We don't have the license to do them. Please. So just note it in case if you see in the exam. So fixed annuity is an annuity that guarantees a predetermined income or level benefit payment amount, which is paid each month for the annuitant's life. That is fixed annuity. You have to allow it to accumulate well. Accumulate and allow for a period for it to mature well. And what's the need of allowing it? You want to be paid with the principal and the interest. So if you have that, you receive monthly income or fixed dollar amount for the remainder of their life. Fixed annuity award derived from the insurance general account, since it is the account that provides an interest rate guarantee and the fixed dollar or income guaranteed. So an insurance company generally accounts holds the deposit of premium collected for fixed insurance. You see one thing, the insurance, the money, what I want to tell everyone is money revolves. Money revolves. You go to put your money in a bank, your bank will turn around to go and put their money in the life insurance where they think they have a secured portfolio. They put their money in the life insurance where they think they have secured place. Life insurance people will turn out to loan money to government, will turn out to put your money in the stocks and bonds. So this is how the money revolve. Then can you invest in bonds? Of course. Can you invest in stock? Of course. But you investing in the stock means that you are not investing in the stock because you are the owner of the stock. You invest in companies that have stocks. And who sells the stock? It turn around to be the insurance company. The main people who have the stock we're talking about. So all this money we are talking about revolves around. So our problem now becomes, as this goes around like a circle, in which part of the circle can we put this money so that it's secured for us, not to lose it? So the only place considered is when you put them in life insurance or you put them in annuity. However, we say life insurance is not an investment. If you decide to put this money on the circle revolving, you go and put it in a bank will return you exactly what you put in. You don't have interest. Because bank will turn around to take that money, put it in that circle, to go and put it in another part of the circle. So what we are trying to let everybody understand now is the issue of you trying to put in the same circle where bank will turn around to put their money. In the same circle, follow them to put it there. Instead of you putting in their own circle, they use it, they remove it from their circle, you put the money, and now go and put it in different circle. So why not remove it from their own circle and put in that circle they are going to put it when the circle is going around? I don't know whether anybody is understanding what I'm saying. Am I speaking to some people? So that's basically what it is. So because of we cannot be able to sell variable product, if a person wants to sell variable product, you must obtain a life insurance license and the FINRA security registration. That is security license. FINRA security registration is security license. You have to get the two before you can sell variable product. And what are the variable products? Stock, bond, CDs, mutual funds. Those are what? Variable product. You cannot sell them. Now, fixed annuity is what is a guarantee determining income and level benefit payment amount, of course, which is paid each month for the annuitant life. You have to design in the way that it can pay you like that. If you do not design it, it cannot pay you like that. So let's summarize. We're going to be fast somehow. To summarize, a fixed annuity guarantee a minimum interest rate on the purchase premium. Income payment don't vary from one payment to the next. For a fixed annuity, the insurer, which is the insurance company, can guarantee future payment because investments are from the general investment portfolio, which invests in conservative long-term government-backed treasures. So did you see it? Some people will say, can't our money lose? Can't our money lose? This is why life insurance is always, an annuity is the best place you can put your money unsecured. Remember, you deposit your money in a bank. If anything happens, I hope you know the highest by law you can be paid is 250,000. I hope everybody knows that. In fact, it's just even because of America. In other countries like the third world country, like, so I'm from Nigeria, let's assume in Nigeria, if the bank collapse, before you get your money back, I think it's another thing. But here, you are guaranteed of 250,000. So why do people turn around to put their money in a life insurance annuity? Because what? They invest in a conservative, long-term, government-backed treasures. So this is why people go there. Government-backed life insurance, government-backed annuity. They cannot fall. They cannot misuse your money. Your money will not miss. So variable annuities. A variable annuity is a contract. Remember, we said in immediate, we are not talking about what? Variable annuity. I mean, a deferred annuity. We're not talking about fixed and variable annuity. We have finished with fixed. We're not discussing variable annuity. A variable annuity is a contract issued by an insurer that allows the contract owner to invest premium in various investment options. Unlike a fixed annuity, this is what? It includes two investment accounts. So variable annuity now have two investment accounts. So you go to where you write variable annuity, draw a two-line, you have two investment accounts. One is general account, another one is separate accounts. So variable annuity has two separate investment accounts, two separate investment accounts or two investment accounts. That is variable annuity has two separate investment accounts. One of them is the general account, and the other one is a separate account. So what happens in this general account? General account provides a guaranteed return. If your money is in the general account, it provides you a guaranteed return. Separate account invests in equity product with no guaranteed return, but higher potentials for gain. So you see why life insurance, the insurance company bears the risk. But in annuity, you, the contract owner, bears the risk. You can see you can see it now. In life insurance, who bears the risk? The insurance company. So that's why you are controlled. That's why you are told what to do. That's why you must follow whatever they told you to do. But in annuity, You have a leverage because you bear the risk. If you decide in these two accounts, you have the general account and separate account. It depends on where you want to put your money. If you put your money in general account, what happens? It guarantees you an income. It guarantees you a return. That is, put a general account, it guarantees there'll be a return. Now, you decide to take the risk because you bear the risk on annuity and life on annuity. If you decide to bear in the risk, you say, no, I don't want to put in the general account. I want to put it in a separate account. It's your own risk. When you invest in the separate account, what happens? The equity, it produces what? Equity product with no guarantee return, but of course, higher potential for gains. It may not guarantee you return, but however, it has higher potential for gain. So, of course, every businessman is a risk taker. However, most people do not want to try this investing on separate account. They want to go to general account where at least they guarantee return. Most people. So it depends on the level of your risk taking. If you have a separate account, of course, you can use one account to do general, the other one you use it to do a separate account. If you have two, or you have three, some people have up to four, some people have six, depending on how much you want. No limits. You can invest in this company, go to another company, invest, go to another company, invest. There are more than close to 100 companies, more than that, self. So you can decide to invest separate account here, go to the other side and invest general account. So let's look at separate account. When you decide to do separate account, remember it does not guarantee you any return, but it has higher potential for gain. So the separate account is unique to variable annuity. Separate accounts is unique to variable annuity because it holds all variable investment options and allow the contract holder to control their investment, assuming the investment risk. So because you assume the investment risk, if there's no guarantee for return, which means if there is any loss, let it be loss. If there's any gain, let it be gain. However, it has higher potential for gain. So some people close their eye and invest on that. So the assets in the separate account are segregated from the insurance general account. So honestly, separate account is good to invest. It's good to invest. You may not have any return, but your principal is still there. You're not losing. If there's gain, you gain. But however, if you're going to gain, you're going to gain massively. But if you go to general account, return is guaranteed for you. So when you are writing an annuity policy, when you reach to this stage, you'll be able to choose the one you want. Whether you want general account, you want separate account. Yeah, you have the opportunity to choose it by yourself. The insolvency protection. Any question? So the insolvency protection, of course, insurance company becomes insolvent. Remember why adverse underwriting was introduced to prevent adverse selection. So then before the introduction of underwriters, remember insurance company paying a lot of benefits. So their insolvency is already there. So because they now introduce underwriting to prevent the insolvency. So the insolvency protection, the insurance company becomes insolvent. Creditors cannot claim assets in the separate account, but they can claim assets in the general account. Separate accounts are generally registered with the Security and Exchange Commission under the Investment Company Act. So another thing that scares people on that, in as much as it has potential for gain, when it comes to collection, you may not be able to collect something on that because of what is registered with the Security and Exchange Commission under Investment Company Act. So that's why most people be scared of it. You can see that why the rich keep going richer and the poor keep getting poor. So the rich people with no mind who have all it takes to invest on separate account, go ahead and invest on separate account and continue to make money. Have flexibility and risk variable. annuity offer flexibility, allowing the contract owner to determine their risk level. Of course.
Excuse me.
Uh-huh.
Yeah, can you repeat what you said in insolvency protection?
All right. You remember when you put in the general account, there's guarantee of return. But if you put in, if you put in general account, there's guarantee for return. But if you put in separate account, there is no guarantee for return. But however, it will give you a maximum return if you allow it. Now, for insolvency protection, generally, if you put in general account, you know that what's going to happen. There's guarantee for return, but how much is going to be returned? Now, for insolvency to be protected, what happened? You put in a separate account. That separate account is registered with Security and Exchange Commission. Being is there, then to claim the assets becomes somehow difficult for you. You cannot claim asset in the separate account. So, meaning what? Insolvency are protected. So you cannot just wake up one day, just go there to begin to, you want to collect, you want to claim, you want to get your money now. It's registered, protected. So you can see this is exactly where rich men put the length they go to secure their money. And it may not be yielding in return for them, but if you use the return, it's massive. So that is insolvency protection. I don't know, is there another way I can?
So if you have money in this separate account, it's protected from your debtors, right?
All these things, everything about annuity and life insurance is protected from your debtor. That's why they do not go to estates when the person passes. That's why company will not, even normally when person passes, we say immediately the nurse call that number, all accounts are frozen. Life insurance and annuity are not frozen. They are very, very protected. So
Okay.
every account you have in life insurance, every account you have in annuity is massively, seriously protected from your estates. No government, in fact, normally if you go to Medicare, like when somebody, maybe when somebody is sick, you want help from government, they make sure that you get everything you have around, the least you can have is 2,500 or 2,000, something like that. But if you have anything in life insurance and annuity, they don't access that account. So that is the only account you can that is hidden from anything. So that's what you said is just correct. But I'm trying to expatiate it. Life insurance and annuity are protected from their estate if anything happens. Yeah. So, but going far investing in separate account means that you still wanna, the essence is to make more money that's secured. You may not be making money, but anytime you make is big and is secured. Just like putting your money, you have a lock, you have a cardboard, you put the money in the cardboard. It means you lock the money in the box, put it in the cardboard, and lock it again. That's exactly what it means. You have a big box, you have a smaller box. You lock it in the smaller box first, then you put it in a bigger box, lock it again. So 2 keys, which means if somebody want to break it, they first have to break the bigger box, unlock it, break it, unlock it, then go inside again. When you get the box where the money is, you still have to unlock the box inside. So that's exactly what it means. That's the best way to explain it. So flexibility and risk. A variable annuity offer flexibility, allowing the contract owner to determine their risk level. Life insurance, in life insurance, the insurance company bear the risk. You can see all the way have been saying life insurance is almost controlled by the insurance company. But in in annuity, you bear the risk. The annuity allows you to determine your risk level, what level you can bear. For instance, this separate account and general account, when I was doing the one I did last week, the annuity I did last week, it came to this for me to select whether general account or separate account. Of course, I choose general account because at least I want guaranteed income, guaranteed return. But let me tell you, if I'm rich, I have the money, what I have done is to say, oh, I want a separate account. Separate account. So it's left to you. You bear the risk. You decide the risk level you want to take. If you're a risk taker, then you go for it. If you're not a risk taker, you go the one that you are sure that this one will happen. So qualification and regulation. To set a variable annuity, a FINRA series of 6. So for you to get security license, you have to go series 1 or series 7. From series 1, 2, 3, 4, 5, 6, or 7, you have to get all of them.
Say that. To sell variable annuity?
To sell variable annuity, which means to sell variable products. You remember I say you cannot sell variable product.
Yes.
Yeah. So for you to sell it, you have to get security license. And security license is in series. You get series 1, 2, 3, 4, 5, 6, or 7. I think Texas here is about 6. Yeah. Series 1, 2, 3, 4, 5, 6. Which means you pass the first level, you prepare, you go and take the second exam, you pass the second exam, you prepare, you go and take the third exam. But if people are doing it, Daniel Fumbo has it. Daniel Fumbo has it. So most people who want actually be in this profession, they want to determine to succeed here, they want to determine to be known here, the best thing to do is to go and get security license, of which I was I'm thinking about this year to start the first series, to start studying the first series. Yeah. So immediately you get your license, life insurance license, you're qualified to start the first series. Buy the books, start reading it, and take the exam. It's exam upon exam before you can get the license. All right. So who remember what we said about sex and FINRA?
Huh?
Who remember what we said about SEC and FINRA?
One is a regulation and the other.
The other monitors the products, and the other one, SEC is regulation, FINRA monitors the products.
SEC.
So,
Can you say it again?
SEC and FINRA. SEC, what SEC actually do is to regulate. FINRA monitor the product. So there's where it was fully well defined. I think we passed it in one of the chapters where I said, please write it down. Sometimes they want to know the difference between the two. Sometimes it comes in fact, often it comes in the exam. Often it comes to the exam. Yeah, I told somebody that day, I think the day we passed it, I said, please write it down. It's very, very important to know it. It's always in the exam, in one way or the other. All right. Let me see whether I can get it again. Let me search my paper. All right. FINRA focuses on regulating brokers and the individual who work on that space. Then the SEC, by contrast, oversee broader security market and public companies.
SEC.
Yeah, SEC.
SEC oversee
security markets and public companies. But FINRA regulates brokers, dealers, and individuals who work in that space. See, this one does not give us a good definition of what it is. All right. So let's FINRA, two of them are authorized by Congress. FINRA is FINRA regulated by SEC, of course. FINRA operates as non-governmental entity under the supervision of Security and Exchange Commission, SEC. So FINRA is under supervision of what? Security and Exchange Commission, which is called SEC.
So SEC
SEC
is the
under
boss of FINRA.
On FINRA, correct. SEC is the boss of FINRA. So FINRA regulates member broker firms and exchange markets. Yeah. There's a way it is defined in life insurance. Can't really remember the exact word they use. Probably we're gonna, in fact, if we see it again, people should jot it down.
So we will be, because somehow two of them are interwoven.
Yeah, so now that we are saying it, I want to see the exact word they use in life insurance business, because although we have known that FINRA is under SEC, but however, I know SEC regulates, and FINRA monitors the product and something like that. That's the little I can be able to remember.
That would be word to differentiate
it's good
them.
we see what the good word they use to differentiate them in here. So definitely we're gonna see. So if you see it again, please jot it down so that you not forget. All right, I think we already done with purpose and performance with all this one. Sub accounts. This one's we're not gonna go through all these ones. We will waste our time. There's nothing. I'm looking forward now to see whether I can see where they differentiate them. Equity index annuity. All right. So in life insurance, you want to go to index. We know why it's called index now. Why do we use the word index? Now we have known why we use fixed. We're going to know why we use index. Everybody wants to go to fixed index annuity, fixed index life insurance. Now let's see why it's called index. Index is just like an equity, of course. Equity index annuity is a fixed, non-variable annuity that offers rate of interest linked to both the funds, that is linked to what? Both the funds are not directly invested in in stock market related index, e.g. the Standard and Poor. So when you hear of index, it's related to the market trend, which are always S&P. S&P is Standard and Poor 500 index. This is what governs the interest rate. This is where interest rate, they say, oh, interest rate is okay. It means that S&P is good. If the interest rate is bad, it's monitored by S&P. We have another one called global. The global is another factor, but that one is worldwide. But S&P is mostly used in America. So there's another index portfolios. Like when you start writing life insurance application, you will see it. If you have written your life insurance policy, you will see the agent at the point with telling you how much are we allocating to this? How much are we allocating to this? So if you have witnessed that, there's a whole lot of about 6 or 7 of them. 6 or 7 of them, of the indexes. Based on these indexes, we determine which one is performing good. So if you put on the one that is performing good, what happened to your account? Your account will perform good. If you put the one that is performing bad, your account is not going to grow. So S&P is one of the ones that perform good. So if you go, most people will they say they put 40 or 50% on S&P, then they distribute other percentage on other indices. So when you start writing a life insurance application, you understand what I mean. So, but for exam purposes, just know what index is. So this form of annuity may also be referred as what? Index annuity. Of course, that is what everybody does. I did it. Index annuity provides the contract owner with the safety of principal. Your principal is guaranteed. You are not losing any money. Unlike 401k, the principal in 401k goes off. Of course, all of us know that. If you log into your 401k now, next morning log in again. If you may see there may have been increase or there may have been decrease.
Decrease.
That's what it fluctuates in 401k. But in annuity, your principal is safe because of what index. Index provide a contract owner with the safety of principal. Your principal is quite safe. Nothing happened to your principal. The most important thing a businessman want to hear, even if a businessman does not make gain, he don't want to see his principal go. If you're a businessman, if you have done business before, instead of you to see your principal go, you will want to let me not get any profit, but let my principal be where it is. Because if you lose your principal, do you have capacity to trade again? No.
Mm-hmm.
So everybody is eager to make sure that his or her principal is not tampered with. So the index annuity provide the contract owner with safety of principal. So since your principal is guaranteed, what happened? A guaranteed minimum return, e.g. 0%, may even not be worried if your principal is guaranteed. So that is one thing that people want in annuity. So what does it provide? It provides a downside guarantee if the market performs poorly. In other words, this type of contract allows the owner to participate in market gain without assuming the risk of a market decline. So because your principal is safe, what happened? You only participate in the gain. You do not participate in the loss. If you're losing, it doesn't concern you. Because what happened? The principal is there. Are you going to lose beyond what you have gained? Of course, no. You only participate in the gain, you don't participate in the loss, which means there's something like a key locked. If the market is gaining, the key will open, the gain will enter the box. If there's a loss, the box is locked. So you can see that this is the greatest place you can put anything.
Mm-hmm.
Because you do not, anything concerning loss is not your business. Is index.
Safety of principle.
Is index. That principle is the great thing that everybody want to hear.
Mm-hmm.
Oh, at least I don't lose whatever I put in there.
Sorry, right there.
So it's a great thing. Everybody want it. But when it comes to, the one that is there, that's why some people will cry after retirement. Because the money they have in 401k has gone almost half gone.
Mm-hmm.
If there is like that time we have COVID, almost everybody was crying. Any small thing. And by history, every 10 years, there's always a thunder block in America, some that make things to change, the life of people to change. Either you have a real estate crash, or you have economic downturn, you have this or that, Every 10 years, there must be one thing that happens. And so as the people's savings will go. But if such a thing happens, does your account life insurance and account in annuity, is it gonna change? Of course, it's not gonna change. It's not gonna change. So that's the thing. Go for the one that protects your principal, please. So this provides a downside guarantee if the market becomes poorly. In other words, this type of contract allows the owner to participate in the market gain without assuming the risk of market decline. And EIA also provide the opportunity for appreciation. In as much as you do not participate in the decline, you participate in the gain, it still gives you opportunity for appreciation. That is upside potential in the stock market. So generally, the contract owner is obligated to remain in the contract for a minimum period, 3 years, each 3 years, minimum of 3 years. So if you're going to do index annuity, you are expected to at least be in that market for at least 3 years. What does that mean? The period of accumulation, if after accumulation, you have to stay at least 3 years before you now talk of return of interest. Sorry, please. Sorry, please. So we are talking about the percentage of appreciation. You see, in as much as your principal is saved, you also have opportunity for appreciation, which means upside potential in the stock market. So you can't beat that. So generally, the contract owner is obligated to remain in the contract for minimum of 3 years. In as what we are saying here is that if you have index annuity, you are at least after the accumulation period, the annotation periods have to allow up to at least 3 years for the annotation period to start. The 3 years you gives the opportunity for the market to work for on your own favor. However, minimum of 3 years, period of 3 years, the more years you allow it to be there, the better for you. So that's just what it is. Then if you now go ahead to say after the accumulation period, you are going to allow the account to stay there up to 10 years, 15 years. You know what it means. You know what you're going to get when you start the payout period starts. So that's annuity for you. In that you're going to receive what? Equal to a percentage of appreciation in the selected equity index over that period, e.g. 10%. For instance, most of them, when you start the business, that's when you understand all this, because you'll be seeing it practically. You'll be doing it. If you're writing an annuity, you'll be seeing all this we are saying. It will not make sense. For now, it may not make sense for you. But when you're writing the product, when you're writing for somebody, you have a customer or an agent who want to have his annuity, or maybe you are doing your own annuity, you understand what we're saying. So this percentage of the appreciation may also be referred to as the participation rate. This is similar to strategy used in index life insurance policies. So this thing is also applicable in index life insurance policies. You can see that most people will say they want index life insurance, universal index life. For instance, if you want to write insurance policy, you want to go to index life. Inside it, although we don't want to use that word investment, inside it, you have a little bit of savings that comes from their cash value. So this is also used, see what you see there? See, this strategy is also used in index life insurance policies. So if you have your account in index life insurance policies and have an account that have a cash value and have a policy that's indexed, you will also be experiencing what we are experiencing here in the index annuity. No wonder why everybody wants to have account have index life insurance policies. So market value adjustment annuity, which is MVA, is also referred as modified guarantee annuity, shifts some but not all of the investment risk from the insurer to the contract owner. So the market value adjustment annuity now shifts some of the investment risk from the insurer to the market contract owner, since the annuity account value will fluctuate with changes in market interest rates. In other words, it is a single premium deferred annuity that allows contract owner to lock in a guaranteed interest over a specified maturity period of typically 2 to 10 years. So let's just move ahead. I don't know what's class. All right. This is the last classification according to the position of proceed, annuity in payment or settlement option. How do you want your money? How do you want to collect your money? That is the settlement option. There's so many ways you can get your money. Unlike the term or whole life insurance policy, an annuity is not a contract that pays a guaranteed death benefit. There is no death benefit in annuity. It doesn't pay any death benefit. Unlike life insurance, with term or whole life insurance, whole or permanent life insurance, where you have a specified death benefit. No, it's not here in annuity. And it does not guarantee death benefit. When determining an income to be paid to the annuitant, the insurer uses a different mortality table with an extra element, which is referred to as survivorship factor. An annuity may also be described by the life payout period of the life or the life contingent settlement option selected. Let's analyze the various options. So the option you can use to get your payout, that's what we're talking about. You can use life payout period, or you can use life contingency settlement option. We're going to see two of them now. You see why I said if you don't know that classification, you miss it all. You see that by the time we go all through them, it's confusing.
So this one is straight life. Oh.
It's straight life. So you see, if you
so
don't.
this straight life, is that we are just doing classification according to disposition of proceeds, right?
Yeah,
So,
what you are doing now is classification based on what? Settlement option or disposition of proceeds.
okay.
I think you wrote those classification down.
Yes.
All right. So we are almost either the fourth or the fifth one. That's where we are now. If you check, we are in the fifth one, either fourth or fifth one, something like that. So, but if you wrote it down, it will help you in understanding it. So,
okay.
It's called settlement option. That is when you want to collect the proceeds. After the accumulation, we have two stages in our annuity. We have the accumulation phase and the annuitization phase.
Yes.
The accumulation phase is the paying period. The annuitization phase is the payout period. So now we are discussing the settlement or disposition of proceeds option. Which means that the payout option, how do you want that money to be paid? That's what we're discussing now.
Okay.
It can be a life payout period or the life contingent settlement option. So we're going to go deep into them to see to analyze those various options. We're going to see them. So let's first of all talk about the contingent options. Remember, how many options do we have? We have what? Life payout period or what? The life contingent option. So let's first see the first one, the straight life annuity. Now, under it, we are getting the contingent option, also referred as the pure life annuity or life annuity. Contingent option, also referred to as the pure life or life annuity. So I want you to, on that place, right on the contingent option, write it can also be called pure life annuity or life annuity.
Pure life annuity, is it the same as a straight life annuity?
Yes. So now let's see. If a straight life and settlement option, which is the pure life annuity or life annuity, if a settlement option is chosen, that's pure. If a pure life or life annuity is chosen, or contingent option, or straight life settlement option is chosen, the recipient will receive monthly payment for life with no refund to their family or any beneficiary. Remember, you have this money, the principal and the interest. During the payout period, if along the time of payout, the person died, there'll be no refund. There'll be no return of the remaining to the family. There'll be no refund to their family or any beneficiary. There is no refund to any beneficiary. So where the person eats finish, the person died, there it ends. Did you get it?
Yeah.
That's immediate life annuity or contingent option or pure life annuity or life annuity. There is no refund to their family or any beneficiary if along the line the recipient or the annuitant or the contract owner dies. Remember, the contract owner can be the annuitant. Since the annuitant is not in the contract, if you appoint another person to be the annuitant, that person is not in the contract. The contract is between the insurance company and the contract owner. So if the contract owner dies, instead of the money, the remaining money or the remaining refund that's supposed to go to the family or the beneficiary, of course, the beneficiary, they will not give them anything because the person choose a settlement option of what? Straight life annuity, contingent annuity option, or pure life or life annuity. There is no refund to the family or beneficiary if the contract owner passes, or that's the thing. So that one should be easy to remember. No refund. So this settlement option exposes the annuitant to the greatest risk because it lacks survivorship benefit, or no, that is no refund. Remember, they can write you a question, they can set a question in the sense that asks which of this type of annuity lacks survivorship benefit. What type of annuity lacks survivorship benefit? Is what? Straight life annuity, or pure life annuity, or contingent annuity, which is a contingent option. Pure life annuity, or life annuity, or you call it straight life annuity. It lacks survivorship benefits. There is no refund. If the person is collecting the benefit and dies along the way, where the person eats, that is where it remains. Whatever remains, nobody
goes back to the insurance
goes back to
company.
the insurance company. So, yeah. So remember, these are the options. It depends on you to choose it. Some people will choose it. So it's left to everybody to make option one. Of course, some people do not have beneficiary. I've seen people who put their dog as their beneficiary. Yep. They don't have any beneficiary. Dogs beneficiary. Some people, you could imagine some people, some people at the point their caregiver becomes their beneficiary. Somebody they employ to take care of them becomes their beneficiary. Some people wrote will and their caregivers are given some percentage of the will.
Wow.
Yeah.
That's a good thing.
Yeah, most people, I have seen it a lot. So if there's no fund, what it means that it also provides the annuitant with the highest monthly amount of all options. Its purpose is to protect against an annuitant outliving their income. This means that a straight life annuity protects against a future lack of money. So in as much as there's no return, no refund, if the person passes, what does this portfolio do? It provides the highest monthly return of all options. They want you, as you are still alive, to take as much as you can. So straight life annuity protects against future lack of money. If you have straight life annuity, you don't lack money. But do not think about your children. Do not think about any beneficiary. You only think about yourself. So the insurer that pay out under life annuity may suffer if mortality rate decline suddenly. In other words, people are living longer, and therefore insurers are paying longer life incomes. So these people will be praying that the person die quick. You see the game? They pray. They pray that the person should die quick so that they'll get some remaining. So the insurance company will be at loss if the person suddenly turn around to live longer than expected. So if the person turn out the person living up to 112 years, 110 years, I'm telling you, the insurance company will be crying because they'll be paying the same amount they're paying to the person. So let's see this. It's in other words, people are living longer and therefore insurers are paying longer life incomes. In addition, since women have a longer life expectancy than men, monthly payment will be smaller for a female if all other things are equal. So they're even afraid of women to give them this policy because they know they live longer. Oh my God. Oh, this is very, very interesting, I tell you.
They are.
You see, there's a point that women are being considered. They're afraid of them because they live longer. So if I go now, my wife go, they will give me fast. They will not, they will not give her. Because they're afraid she's going to live longer. So they're going to pay at the point they'll get tired of payment.
It's not reality of life. Many people also, or many women die before their husband too.
Yeah, but that's assumption now. There's always assumption. But most times it's always 80% true.
Yeah. 20% is something.
It's big and it's big. No, it's 80% true. That's the truth. And that's why even in life insurance, if you write policy, men's policy are so costly, so expensive. Yeah, than women. That's the truth.
Plus the risk you guys take.
Yeah, because of the risk, that's the reason why everything is expensive. So that's why this insurance company, they know that if you do immediate annuity, they will gain. If man do it, they will gain because they know the men might not live as expected. But if they see women, they don't want to give it to them. If they want to give, they're going to lower the monthly income.
That's discrimination.
No, it's business. They know that the women will not die quick. So you don't blame them. It's business. So annuity period certain. So if you decide to choose annuity period certain in the payout, an annuity period certain or period certain is a description of income or installment for a fixed period chosen by the owner. This means that what? The monthly income will be paid for a specified period, only not for life. So you see the difference? Immediate annuity give you for life. Then annuity certain or annuity period certain, you have to specify the period, how long you're going to get the money. It's not for life. So what happens? Payment ceases after the specified period. If you choose 30 years, after 30 years, the payment stop. Let's assume the person died before the 30 years, then the beneficiary will come in to get the remainder of the money. So this is what happened in annuity period certain or annuity certain or period certain. So I think most people goes for this. But you cannot compare this, the yield, the profit, the benefit derived from immediate to this one. You see that the amount of monthly income you're going to get on the immediate will be more than this one because what? The insurance company will give it to you, knowing that the person dies, they will get the remaining. But for this annuity period or period certain, there is always a beneficiary. If they are paying anyone that remains, they give it to the beneficiary. When we're talking about what remain will be the principal and the interest. So I think you can know, you will be able to know, even if you see it in the exam, you'll be able to know the differences, the one that have beneficiary and the one that doesn't have beneficiary. Annuity period certain or annuity certain has beneficiary. Immediate annuity doesn't have any beneficiary. So life annuity with period certain. We have annuity with period certain and annuity certain or period certain. Annuity certain or period certain. Now we have life annuity with period certain. So what happened in this one? A life annuity with period certain pays a guaranteed minimum benefit. An income is guaranteed. They pay it to the annuitant life or a specified period for a specified period, whichever is longer. This means that the contract pays a survival benefit if the annuitant died before the end of the period certain. So this one and the period certain is the same. They have what? Beneficiary. They pay in a period, whatever remains, they give it to the annuitant. I give it to the beneficiary. I think life with refund option. All these are payout option or the way you're going to collect the money. Of course, if you do it, if you're a contract owner, you see all those. Sometimes you get confused. If you do not know it, then the agent will explain to you each of the options. Each of the options that will be better for you. However, before all those, you must have known your client. You must have done a need analysis of him or her. That's why when you are talking to somebody when somebody is talking to you as an agent, you have to open up. Do not hide anything because if you hide, it's your own detriment. It's better you say it as it is so that the person can be able to design a contract that will fit you. Yes. If you do not have any beneficiary, if you're not thinking of any beneficiary, say simply you don't want any beneficiary. You get more. If you want beneficiary, say you want beneficiary. So based on that, the good option that's good for you be designed. So life with refund option, with life refund option annuity, the contract owner makes a premium payment to the insurer throughout their life. Still, the contract also assures the return of the original amount paid into the annuity contract. That's the principal. If the annuitant dies before the principal is distributed, the beneficiary receives the remaining amount. Due to this guarantee, the premium for a refund annuity plan is generally higher than that of other annuity plans. You can see something here in the life refund option. Is talking about the principal only. You are investing the principal. They are not talking about attaching an interest to it. It's a contract that makes premium payment to the insurer throughout their life. You make contract payment. You make premium payment to the insurance company throughout the person's life. And the contract also assures the return of the original amount paid into the annuity contract. That is the principal. They pay you back the money as a form of principal. They do not consider the interest.
The interest.
Yeah. And if the person along the line, the person passes, what happened? The remaining one will go to the beneficiary. So this one, life with refund option, is I think it's difficult for somebody to consider it. You don't have any gain. But unknowing,
I wonder why anybody would get into this if only the principal is paid.
yes,
It will be paid.
The
Why
problem,
did?
you say you wonder why. Some people who do not understand will take it and go their own way. Let's take let's take this one and go their own way. Of course, I see people who wrote policy for somebody and did not give him deny him of any rider.
Aye.
Even the free riders. One thing people should understand? You see, sometimes we take our time educating people. Some people don't have this time. They got the last and they enter the business. They do the business. We have seen several. No, I'm telling you what I have witnessed. We have seen severally where agents write insurance policy for people. They excluded riders, free riders.
Oh.
So is knowledge. You have to know it to do it well. That's the truth. You have to know it to do it well. So remember, annuity certain guaranteed payment to a specified period. A refund annuity guarantees the entire principal will be paid, either to the annuitant or to the beneficiary. So why was just like you asked, why would somebody go to this one?
Why?
So classification according to the number of lives. All right, this is the last one. Classification according to the number of lives. That is the fifth classification. Classification according to the number of lives covered. Remember, in life insurance, we have joint and joint with survivorship. We have that in life insurance. So in here, we have individual or single life annuity, where one person is only the person, individual. My own too was individual. An individual or single life annuity is the most common annuity. It's the pure life annuity covering one life with no survivorship or beneficiary. No, my own is not. I have a beneficiary of mine with no survivorship or beneficiary. Once started, it provides the recipient with income for life with no refund paid to anyone upon their death. All right. So in this one, you do not individual or single. You do not have a beneficiary too. So some people have individual single life annuity without. What does it mean? You don't have any beneficiary. If you die, there it ends. Why this option pay the highest benefit amount? It has the greatest risk to the annuitant. Since there is no survivorship, no refund. Its purpose is to protect against outliving one's income. So you can see that one that give you protect you against outliving your income. Most of them are what They don't have survivorship. Single annuity, single individual or single life annuity does not have any survivorship. However, it pays you the highest benefit amount. If you are taking it monthly, it's paying the highest amount. If you're taking it annually, it pays the highest amount. So let's look to joint life. Joint life annuity is a type of multiple life contract that pays benefit to two or more annuitants simultaneously. Husband and wife can do joint life annuity. However, all benefits will end upon the first annuitant death. Remember, in life insurance, if you do joint life insurance, who can tell me what happens when you do joint life insurance, joints?
So it depends if it's a joint one, when the husband or one of them died, the other will take the remaining whatever.
Yeah, that is joint life, that you are correct. So, but look at what happened in joint life annuity. In joint life, what we say in joint life life insurance, if one person died, the second person will get what? The death benefit.
You know, the first to die, second to die.
Yes, that is first to die, second best. Then look at what happened in joint life annuity. In joint life annuity is a type of multiple life contract that pays benefit to two or more annuitants simultaneously. So here, since this is something you guys have invested, to husband and wife, is paying two of them at the same time. When it's time for payout, two of them are benefiting at the same time, simultaneously. However, all benefit will end upon the first annuitant died. Immediately the first person died, no more payment.
Oh.
So that is it, no more payments. But when two of you are still alive, they'll be paying the money simultaneously. But if one person dies, no more benefit. So check on life insurance. If one person dies, the second person will take the benefit. Contract
This is
end.
confusing.
No, it's not confusing. In life insurance, if one person dies, the second person take the benefit, contract ends. But in joint life, two of them are taking the money. Joint life and two of them are taking the money consecutively, simultaneously. Then if one person dies, benefit stops. So that's joint life. Then look at joint life survivor annuity. Whenever you see survivor, it's telling you that it's a beneficiary. But in joint life annuity, is there any beneficiary? No. In joint life and survivor annuity, there is a beneficiary. So a joint survivor annuity is another multiple life contract. With this type of annuity, the benefits are paid throughout the life of one or more annuitant. Therefore, payments continue until the last annuitant dies. In other words, joint and survivor annuity guarantees income payment for the duration of two lives. So if one person dies, what happens? The other person continue. So payment continue until the last person dies. So
One is if they first die, the second will not take until the second dies or something like that.
On the life insurance policy, if it's joint life with survivorship, the first will die, the second will die, then the beneficiary will collect the money. First to die and second to die.
But
First
in
to
annuity,
die,
it's different, right?
the annuity is different. Yeah, that's what I'm trying to explain. In annuity is different. In annuity, if you have joint life, two of them will be collecting the money simultaneously. Then if one person dies, what happens? The money ceases.
Oh, really?
Then in joint and survivor annuity, two of them will be collecting the money. If one person died, the other person still be collecting the money until he dies.
So until he dies, no beneficiary.
No
The second
beneficiary.
person dies.
Yeah, no beneficiary.
This is interesting.
So you gotta grab it well like that, otherwise
Yeah.
get confused. So these four of them, if you relate it with life insurance, it's quite different in terms of operation.
Yes, that is what I'm understanding now.
Yeah, it's quite different in terms of operation. So surrender charges. In every contract, there's always a surrender charges. That was what all of us should know. There's always a surrender charges. Surrender charges exist even in life insurance. When you cancel your contract, you're gonna pay some surrender charges. The surrender charges is the expense charges of which the insurance company are used in managing your account. You're gonna pay it before they will give you back your money. More especially in annuity. You're gonna pay it, they pay it from the principal and the interest, and you pay interest on tax on the interest, depending on the funding. They're gonna give you back the principal and the interest. So in other words, you're not losing. What they're gonna charge you is the surrender charges they're gonna charge you when you cancel the contract when it's not supposed. You know why they do that? Because they are still making money out of your money. So we talk of non-forfeiture values. Remember, non-forfeiture values, we have it in life insurance. And in non-forfeiture, we said in non-forfeiture is a part of the money that comes from the cash value. We say you pay interest on the what? You pay tax on the interest, which is the accumulation. So annuity contracts also identify a fund of non-forfeiture value, which represent the fund value less earned any surrender charges if the funds are being withdrawn. As this case of certain types of qualified retirement plan available today, funds may be withdrawn without assessing surrender charges if the owner dies, become disabled, or require specific types of extended medical care in a skilled nursing or extended care facility. So that is it. So surrender charges are what this designed to make moving money out of an annuity less attractive to the contract owner. So because the surrender charge is going to pay, it makes you not to touch your money. You don't want to go and start paying unnecessary fee. Except that thing is holding you at the back, probably because of death or disability or specific disease. In that case, you're not going to pay any charges. You're not going to pay any fees. They'll just give you back your money to go and take care of yourself. And they will do investigation to find out whether what you told them is true or not. Remember, this is America. So they are different from the 10% federal tax penalty for a premature or before age 59 withdrawal. If you all right, another thing I want to tell people, if you want to go roll over your 401k to annuity, just like in annuity, you're based on the charges. If you go and take that money, you're not up to 59 and a half years, you go and take it. Remember, the same thing that applies in 401k. If you keep that money in 401k, we apply in annuity too. Because it's Uncle Sam money. He's monitoring his money. He doesn't want you to eat your own, eat his own. So before amortization, the non-forfeiture value of an annuity equals all premium paid plus interest minus any withdrawal or surrender charges. If the annuitant dies before the annuity period starts, the beneficiary receives the premium paid plus interest earned. So that is it. In fact, if you are writing this thing down, the way you're supposed to write it down, you're not going to miss nothing.
Yeah, if you finish writing it down, remember, that's the brain. Yeah.
No, well, not
doing...
all of them, at least some points, just some point that will make it. If not, you will not get it all. And that's the truth.
It's a big fool.
If not, you will not get it, you will not get it, you will confuse it.
It's very, very.
It's confusing. And that's why if you do not pay attention to it, when you go to the hall, you see this one, you're thinking it's the other one. But if you go to that and jot down at any time you bring it up and see, you know that you remember it, how it's structured. So this guaranteed minimum withdrawal benefit. guaranteed minimum income benefit, and guaranteed minimum accumulation benefit.
What section is this, or how do we clarify this? It's just by...
No, we finished the classification.
Okay, so this is
we
by
finished
itself.
classification. Yeah, we finished classification. Classification end on classification according to the number of lives. This is where classification.
So it ends on number of life, non future value. That's where we ended.
So this is additional annuity characteristics and aspects. We have to talk about surrender charges for future values. Then what we're going to talk about now is guaranteed minimum withdrawal benefit. We want to know what it is: guaranteed minimum income benefit and guaranteed minimum accumulation benefit, and what long-term care rider. So it's like we're going to end here this afternoon so that everybody can go do it. In the evening, we start from here, 57%. Annuity is such a big chapter that it's not even good to rush. It's good when you do a little bit, you stop to digest the one you did. Because it's confusing. It's a big. But believe me, if you understand it, you will like it so well that you want to invest.
But this is the heart of the whole thing.
Yes.
For anybody, yes.
If you understand it, honestly, if you understand it, oh my God, you want to invest any small amount you have on it. It's so good. I have, despite this, I think last year I put some money on it. Yeah. I did last year. I put some money on it. It's just like that thing they do in bank. Is it a CD or what? But CD, you're not sure of how much you get, you're not getting anything. But this one, the interest is what is amazing.
This guaranteed minimum withdrawal
benefit, guaranteed minimum income benefit. I said we're gonna stop here this morning so that
we're gonna stop here.
Yeah, we're gonna stop here because it's getting much.
Okay, so the person that is going to exam, is she still here?
Yeah, that's what I want to ask now. The person that's going to write the exam today, is he still here so that we know what to do?
Maybe the person has left.
So if he has gone, then we can come back in the evening to continue from where we stopped.
Okay.
It's good as we're taking it bit by bit because it's always like that.
Okay.
It's always like that. So try go through the ones we did so that when we come back in the evening, if you have questions, we answer the question before we start.
Okay.
We are about 57% now. Believe me, we may not even finish it today. Maybe tomorrow morning.
Okay.
Yeah. All right.
Thank you. Thank you.
See you guys in the evening. We start by 6 p.m.
Yes.
Even if I did not send post it, 6 p.m. we are starting.